Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to sprinkle in all sorts of opinions as I go through it. It's going to be related roughly to three topics: wealth building, financial related topics, and or commodities. Commodities includes precious metals. I'm a huge precious metals bull right now with the developments that I'm seeing, and I'm sharing a lot of information that's probably going to be precious metal related as we see the tide turn. All of this is interconnected, and it could mean something. It could. And I'm going to go through the information and tell you what I think it could mean, deciphering it, at least from what I've read and understand about the market. So I'll decipher it for you here, and we'll jump in here, and I'll give you my opinion. Again, if you want to follow me at finding_finance, and if you want to join our community where we talk about individual companies, individual sectors, how to play this upcoming commodity bull market, you can ask me questions directly. Join finding-value.com. We still have a discount code going on called Turkey. Look at the details in the description link underneath. CEO Technician, he says, a banner day for the gold mining sector. The big three producers, Newmont, Barrick, and Agnico Eagle, however you say that, tacked on more than $6 billion in market cap between the three of them during today's session. AEM is breaking out from its head and shoulders bottom, 5% on more than 2 times average daily volume. The rotation is starting to occur. It's right in front of us. We have lots of opportunities here, guys. Lots of opportunities. Here's AEM, the inverted shoulder, head, shoulder. The neckline's the blue line. We're seeing exactly what we want to see on a neckline break, a big green candlestick. They call it the green army shows up. And there's your volume indicating that there's some big buyers coming in here in terms of volume. Here's the other one. It's still an inverted head and shoulders to some degree. It's a little bit jacked up, but that's moved on up 6% for Newmont. Pretty big volume. And then another inverted shoulder, head, shoulder, drawing the neckline across, and the break for Barrick Gold with good volume. I like that the volume extended across all these different companies. We want to see confluence. Confluence is what we call a merging of information that paints a bullish or bearish picture across the board. To me, this is painting a bullish picture across the board for gold and silver mining companies and the potential bottom that we're getting here. Now here's North Star. He says uranium, massive bull market appears to be ongoing with another big move if this support fails. So what is he talking about? He's talking about the currency in circulation, which is basically currency in circulation. It could be M2 versus uranium miners. It says, please examine this chart carefully. If told correctly, it correctly told us we need to take positions in the uranium sector for large gains. This type of technical scientific evidence is what we use every day on our website and enable us to grow our NRV even when the stock markets, precious metals, and crypto have been falling in the last 2 years. So as an investor, there's a couple of things that stick out to me. This is how you make a boatload of money, and I'm going to try to explain it to you as best I can, and some of the early signals that I use even on our membership to take positions in individual companies. What we see here is a big move up. We see a rising wedge. That's a bearish rising wedge. Now, we can also see these wedges formulated downward, which is called a falling bullish wedge. We're seeing the falling bullish wedge in a lot of commodity stocks as we go. Here, as he's exampled, and this is a ratio chart, he's charting currency versus uranium miners. So this chart, when it falls, is bullish for uranium, bearish for currency. Now, what we saw is a squeeze in this, and it broke to the upside, and people would say, oh, well, that's super bullish. This should run to the upside, but look what occurred. This is a false breakout. We see it all the time. False breakout, big bearish engulfing. So this false breakout went right into a bearish engulfing. A super aggressive investor would take an entry point right in this section in here. It's like right when you get the bearish engulfing, you start enter, cost average in, and cost average in as it breaks down below all these moving averages and all the trend lines that we've got here. Now you should be riding it. We had a consolidation, no big deal, bearish rising wedge, and then we've broken to the downside. We still have some support. That's where the wicks are on these candles here. There's some wicks on the candles here and here as we came back up right underneath it. So there is some support that we have to bust through. But uranium looks like it's going to outperform currency in circulation. And that just means that money is rotating into the uranium miners faster than what currency is being created. It tells us that it's a preferred investment during the market condition that we're in. There's a whole bunch of setups similar to this, but flipped and inverted in a falling wedge, and they've broken false breakouts to the downside. That's where I'm loading up. That is how you get the biggest gains, is to buy when everyone is looking at different sectors. Let's just say NVIDIA, tech, or whatever. You buy the stuff that no one's looking at. Eventually, there'll be the people FOMOing in later on in the bull market. I'm not talking about uranium. I'm just talking about in general. Bar chart. So here's, this is sad. Charlie Munger passed away. I mean, he is 99 years old. I hope to live a healthy life, and hopefully I hit an age somewhere around there. But it sucks that he passed away. Not that I knew him or anything, but I don't like seeing investment greats pass away. Betting on firm oil prices, which depend on artificial supply curtailments, is a risky bet, according to Michael Blair. It is time to take some short positions in energy names to hedge long positions. Best shorts are those who have little to no dividend and continue to have sizable debt levels. MEG, TVE, and CPG are my choices. Good luck with that call, buddy. We've got a lot of people that are positioned on the short side, not on the long side of oil. I would not be taking that bet. I think it's too tough of a bet. One, we just broke a downtrend in oil, and it looks like it wants to go higher. Two, everyone's already bearish. So you've got the price down here at $75. This is not the time to put bearish trades on it, in my opinion. It's time to go long. Here, I'll just say this. It'd be a better move, in my opinion, to go long oil than it would be to go short, given where the sentiment is and where the pricing's at, in my opinion, and where we've broken down trend lines. A better bet would be to skip it all in its entirety and go after something that I think is coming into rotation, which is gold and silver and platinum. I mean, that's what I would do. I don't know these guys. If you're going to try to short something, short it when it's really, really high and it just lost momentum. You don't want to do it when you've already pulled back to $75 from 120. It's basically already been cut in half. I think by looking at the fractal of oil, I mean, maybe we've got a hair more downside. Maybe, I doubt it. But if we do, I would consider that to be a buying opportunity, not a selling opportunity. So I'm in stark contrast with Michael Blair. I think going long oil is a much better bet than trying to put short positions on it at the location we're at. Says, oof, this is not going to be pretty. And he's talking about natural gas storage. If you look on the right-hand side, we've got 2023 coming through here. We are on the upper levels of storage for natural gas. We need cold weather to draw this thing back down. We've been producing a lot of natural gas, hitting all-time highs, et cetera, et cetera. We could get a slowdown in natural gas in the beginning of 2024. The problem is when all the capacity comes on later in 2024, it's going to take it all away. So there could be a lull before the big move in natural gas, a lull in the beginning of 2024 if the weather doesn't draw down inventories of natural gas storage. Scroll in, we've got Charlie here. He says the US money supply fell 3.3% over the last year, a record 11th consecutive month with a year over year decline. But guess what's making up this difference, guys? There's something making up the difference. It's called the reverse repo. The reverse repo has been putting liquidity into the market at the same pace that the M2 money supply has been declining. So it's not really been declining. The reverse repo is actually coming in there and filling in the gap. So we still have inflation. How bad is sentiment at the moment? Almost historic. And that's what I'm talking about going long versus someone who's trying to put on a short. This is net oil length, non-commercial. Look where the circle is here, guys. Look at that. We've got that circle there. I'm going to yank it in just a little bit. That's where we're at today. 2020, this is 2020 here. You can see in 2020, we got down to that level once. In 15, 16, 2020, 2022, and 2023. Now, if I put something here, look, this is how I would view this, all right? Draw a line through here. Draw a line through here. And what do you get? You get a breakout and then a retest. I would be buying oil. I would be going long oil. I would not be going short. So, I mean, obviously, I'm telling everyone here, whoever's listening, you can see if my call is correct or wrong. Going longer, long oil, end of November, early December is going to be a good bet, and I bet you will be higher here in the short term, and I bet you net oil length is going to go up, not down, from some months or 6 months from now. Silver keeps going for what it's worth, now breaking the monthly downward sloping resistance. Lots of clear open space next to it. When silver moves, historically shows a 100% plus move. Get ready, guys. We're about to break this downtrend line here very soon. Big move to the upside, and it can move very quickly. Now, I want to pull something else up here just to get you guys in the mix here. So this is silver futures pricing. There we are. We've obviously broken to the upside. It looks like after hours it's even up even more. Oh, we're breaking, guys. This is going to be fantastic. We're breaking to the upside already. All right, so this is the silver chart. This is going to be a big silver squeeze. You guys have been waiting for this your entire life. Even if you don't know that you've been waiting for it, just know that I've been waiting for it then. This here is a big cup and handle. All right, this big cup and handle is breaking right now. What this is engaging is a massive, massive chart pattern break. And I'll be honest, guys, I want to help you. Now's the time that you should reach out and get help if you want the help. Because this is going to change, potentially change some people's lives if I'm correct on this. This pattern, if it breaks, what I have up here is this here. This is your neckline here. It's your bottom to the neckline up here. And the neckline will change a little bit depending on your time frame that you use. If I put this on top of the breakout, I get a projected move that goes into around $277. If I run the upper line, I get $425 if you take the top of the cup and handle. So somewhere between 200 and 400 and something bucks is a potential breakout and move for silver. I care about the people who are listening to this thing. I know it's like, oh, yeah, right. No, I do. I really do. If you're listening to my channel and you've been with me for a while, I want anyone who's part of the community or people listening to this, I want them to be successful. This here does not come often. This setup does not, you're going to get it once in your life. And you got to take a stranglehold on it and say, I'm going to position in this correctly. Because it just doesn't come around that often, guys. So this is the opportunity. It's breaking out again. It's over 25.50. It's starting to roll. And again, if you want my opinion, if you want to talk to me directly, sign up to the website. I'm not trying to sell you anything here, but this is a big deal. It's a big deal, and it can change your life. And I'm just hoping that I can help people do that. That's all I'll say. Gold's also ripping it, guys. We're up 25 bucks here after hours. That looks pretty good there. Pretty good. All right, going on back. Grady says, agree. It could be, but more probable is that it's a megaphone continuation pattern that has corrected mostly in time instead of price, and which will break to the upside. And what is he talking about? He's talking about gold. Gold is going up, and what this is think of this as the stair step pattern that I always talk about. You get a big move up, and then it consolidates. A big move up, consolidates. Big move up, consolidates, and it's probably in the middle of a big move. This target is $10,000 to $15,000 an ounce gold. And what that's going to do is it's going to account for the money supply in the system. What he also has correctly identified is this is the fifth Kondratiev wave. K waves have lasted 54 years on average. Says note that the Kondratiev macro cycle is a so-called long cycle and is not to be mixed up with the tool cycles analysis. Examples of other long cycles are the 15-year commodity cycle plus the 18-year debt cycle. This guy's got it nailed down, man. I watched the 18-year debt cycle, and I know that we're at a beginning of a commodity cycle, and then we've got this Kondratiev wave that is overlaid on top of this. This possible time span for the fifth K wave to top. If right translated, then we top beyond 2028, which would be very reasonable for this bull market. And we top in 2034 if the fifth K wave is similar to the fourth K wave. So the predicted top is somewhere around 2028 to 2034. And all of the research that I've done puts the top in late 2020s, early 2030s. So it's almost the same exact top that I get with the stuff that I look at. Gold mine supply will hit record high in 2023 while silver production peak occurred in 2016. Even with 60 million ounces of new silver mine supply from those dates, production is down 60 plus million ounces. It's going to get interesting here, guys. We've got silver demand increasing rapidly. We're running massive deficits in silver, and the supply of silver is falling. I love it, boys. I love it. Gold is on the verge of a historic breakout, and the US dollar is on the verge of a historic crash. This will be a game changer for the Fed and the economy as it will send inflation, interest rates, and unemployment soaring. Forget about a soft landing, it's a crash and burn. We got Eric here. It says Rystad's real-time cube showing a meaningful uptick in global gasoline and diesel demand in the past few weeks to record highs. Look at this move here, guys. Meaningful uptick in all of these demand. So what the heck is going on here, right? What is going on with the price of oil? I think we're going higher. I think there's a mismatch in the market right now. And I think oil is going to follow where gold and silver is doing right now. It's just going to be lag behind it. It's going to be lag behind it. Gold, so that's really a beautiful chart. We bought the very lows at the service and now riding this move. We'll be posting lagging companies soon, equals the second wave up movers. This is the falling wedge in GDXJ and the break higher out of this falling wedge. Looks fantastic. I like what Patrick's saying here. Are you watching this? Sprott Physical Gold and Silver Fund. 12-year line breakout. Let me get this thing moved in a little bit. There we go. Look at the volume too. We're starting to break out of the Sprott Physical Gold and Silver Fund to the upside, basically breaking that downtrend line, which he puts as the paradigm shift breakout line. We're all there, guys. It's ready to go. This is the time to make a boatload of money in gold and silver. Now, I read this and I got confused here, guys. He says, stop the price gouging. Biden hits corporations over high consumer costs. What? He says any corporation that has not brought their prices back down, even as inflation has come down, even as the supply chains have been rebuilt, it's time to stop price gouging, Biden said. I'm sorry, I read this and I just thought this guy is completely like this statement is false. It's coming from him and government spending. The companies cannot control, I mean, they can control their price, but they can't control their input costs. All of that comes from the government. But I do like that he's got his mouth open. It makes him look very intelligent picture here. I really do like that. And here's another thing, too. It says for the 19th consecutive month, the Dallas Fed's manufacturing outlook survey was negative. Now, if I look at this, the best time to buy, looking at history, and I were to pick the best times that I could enter stocks, where would they be? It would have been right here in 2009. It would have been another really good spot was in the beginning of 2016. There was a lot of mining companies that were really, really low. Also, right here at 2020. So if we're coming back up out of this, and you can see that we're negative here, I think this is a good time to buy, not to sell. You want to buy when the data looks the worst. And right now, it doesn't look good. So again, I think the data is going to get better, not worse. We've got the CRB Weekly here. He's talking about what he called back in 2020. I just thought this was crazy, though. We had the consolidation here, and then we basically diarrheaed out of it, false breakout. And this would have been a huge buying opportunity for anyone that was paying attention. The ratios were at all-time lows. We had fear, panic in the market. It was just an all-around great time to buy. And it also correlates with this big mover in the negative sentiment. So buying when the sentiment is negative, buying when there's fear in the market is uh, the time to be brave. That's where you're going to make all the money, guys. A lot of the money. In one word, what stops people from being disciplined? I think the thing that stops people from being disciplined is it takes work. It takes you to do something. And I think a lot of people are just lazy as all get out. So me coming in here doing all these videos every single day, doing all this stuff, it takes discipline. And it's something I want to do, but it's also something that I think I have to do. It's a part of what I think needs to be done. And I want to help people be successful in the opportunities that are coming ahead of us. And I think that the markets are really hard to navigate at the current moment. So I want to make myself useful. And the best reward that I can have is to help others become successful. It makes me feel like I'm doing something with my life. I'll just say that. So I think that provides discipline is creating a vision, creating a goal, creating something where it feels like you're making a difference. And I have strict discipline. Like my diet is very strict, not super strict, but it is pretty strict. I always work out. I don't miss things. I'm not saying that I'm lifting. I'm not He-Man over here, but I'm trying to get my workouts in and stay healthy, keep weight off, and do all that stuff. Now here's another thing. This is U.S. is near extreme peaks versus global equities, well exceeding the 60s, 70s, Nifty 50, and 2000s tech bubble. Look, we're way out in no man's land. Now, I'm just gonna say this, guys. It is hard to make money with valuations up here because what you're trying to do is you're trying to go a little bit higher. I think this thing is toast. I think it's toast. I think that global equities are eventually going to come back down. And I don't want to put a date on it, but I think over the next few years it's going to roll over. That's what I think. And I think commodities will be what takes up the slack to the upside. I says most rising wedges are bearish, but in very bullish moves, they are sometimes continuation patterns instead of reversal patterns. This is U.S. federal government interest payments 50-year chart. Look at this. Squeezed up, breakout, retest, gone. Gone. That's the interest payments. I would not want anything to do with interest payments. That just looks horrible for them. What a bad situation they're in. Gold's going to follow this, guys. Gold's going to rip. Silver's going to rip. We're going to follow all of this debt problem to the upside with precious metals. Now here's URA versus the SPX. This is a breakout. You can see the RSI breakout clear as day on the bottom there. We have a breakout to the top, and this is what potentially could occur in URA versus the SPX ratio. A 15x outperformance. It's a very probable, enormous reverse symmetry move coming. And everything I can tell is positive for this move to occur. So I know we've got some people out there, sell uranium, buy copper. I just shake my head like, guys, there's so many opportunities here. I think you need to get spread across a lot of the opportunities and just sit. Sit, 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 sit. Don't do anything. Find the good companies, find the good entry points, take the entry point and sit. Take these guys, the girls and guys, these so-called experts that are telling you, sell everything. There's this and that. I don't know, guys. I am so distrusting of everyone that all I can do is follow and guide myself and not listen to these other people. Follow the charts, follow the ratios, follow the market conditions. You do those three things, you will be successful. And I can help you be successful if you need help. I don't want to turn this into a big commercial. I don't want to do that, but that's what I'll say. Now, there is some negative news that is coming. A debt default has definitely started. The biggest surprise coming out of COVID is how much of a lag there has been an effect of the rate hikes in the economy. The trillion in stimulus have masked a lot of pain in the markets. It doesn't mean it's not there. Now, this is a default cycle. Things are coming to the upside for some things that are defaulting. That can be a deleveraging process. Now, the problem is, has that already gone through the system? Is this going to turn back over? We've got the major portion of the market still intact, which is the real estate market, residential real estate. It is a very hard play to get this in the short term right. And that's where it's like, get in the investments, get the good entry points, and just sit in it. Create a portfolio where you have so much symmetry to the upside, where your 10x, 20x upside returns can overwhelm anything else that's in the portfolio if it were to go down 20, 30, 40%. Your portfolio would still massively be higher. So the way that you position the portfolio is highly important to the success if something does come. Now, you don't have to be up on the portfolio 100% of the time. I know some people, they think they can avoid every single pullback. What I'm going to say is, I don't think you can. Ride through it is what my strategy is going to be. And on the other side, we are going to probably print a bunch of money, which is going to it's going to send gold and silver to the moon, and it's going to send oil to the moon, and all of the energy sectors and some of these mining metal sectors. So the key here is to stay long and be able to weather volatility. Be able to weather the volatility for that to occur. It's coming. It's just a matter of time. Here's sugar and silver. They track each other very well. We're about to break to the upside for both of these. And that's occurred every single time we get these large inflationary, moves. So inflation's here, guys. Get ready. It's coming. Here's Grady posting a gigantic big picture view of gold. I love it. I love the big picture view, guys. This is what I invest for. Very big picture view. We've seen it in the 70s bull market. We saw it in the 2000s. And now we're in the final third bull market. Now I'm gonna try to tell you guys something that's just ridiculous. All right. The 1970s was an increasing interest rate environment. We went into a declining interest rate environment from this blue arrow all the way to where we are basically over here in 2020. The arrow would be over here. This new thing that's coming is under a increasing interest rate environment. Why does that matter? Who cares about the increasing interest rate environment? Well, let me explain, all right? An increasing interest rate environment is going to shove more money around the system differently. Increasing interest rates means that there's a larger rotation of money out of bonds. It also could impact the S&P 500 in a larger negative way, which will rotate more money into gold, silver, platinum, and a lot of these other commodity sectors. So I think of what's coming is going to be very similar to what occurred in the 70s. So based off of the interest rates and the market conditions that those interest rates put on, the masses or the herd. So here's another one. A brief decline. The percent of yield curve inversions has returned to extreme levels, now approaching 90%. Again, the Treasury market continues to scream a recession's ahead. The fact that a recession hasn't happened doesn't necessarily mean that the likelihood of one happening has decreased. And this is what I was talking about before. Timing these things is incredibly difficult. We can stay inverted for a long time. We came back down to uninvert, but now we've basically come back and inverted back up to 87%, which is way up here. We stayed inverted in the 70s, the late 70s, for a long time. See how this stayed inverted and then we crashed later on? That was also a crash from the real estate market. This was a real estate market crash. Notice how we went back and forth up here for a while, 70s. I think we're going to oscillate up here for a while, where the yield curve stays inverted for a while. The reason I think that is because the housing market hasn't been overbuilt. I don't think a big, huge blowout crash is going to occur from the real estate market. Now, there could be a slowdown where we come back like the COVID recession. We could get something like that. And that is something that I think would be very difficult to project. So this was a housing bust, this was a housing bust, this was a housing bust, and this was a housing bust. Even though they said these double dip, it's a housing bust, housing bust. Housing bust occurred in 1990. We overbuilt. This was a tech bust that I probably wouldn't have seen. Like it'd be very difficult to get that because it wasn't originated from the real estate market. Housing bust, and this was something that was originated that they slowed. They basically shut down the economy. So there's got to be something coming from somewhere else that I'm not seeing that's not real estate related. If this were to come back and uninvert. This is gold to SPX, just turned bullish. Actually, let me go back here. Sorry, guys, that was not it. And that's where I'm going to end it, guys. That's what we've got. So give me a thumb up for the content. Subscribe to the channel if you haven't already. That's what we got going on. I'm uber bullish gold and silver here. It's looking absolutely fantastic. And I've got the midweek update coming up Wednesday today. Look for it today after market close. I'll update you guys on what I think looks good in the markets and what companies I would be looking at and going and purchasing. It's probably going to be gold and silver related and some other sectors that also look really good, like energy service. Some of these other ones, they look pretty good too. So that's what I've got for today, guys. Hopefully you're all crushing it, and we'll catch you later. Finding value.